Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today we continue our educational series, Bitcoin and Liquidity Academy. In our first lesson, we went through understanding balance sheets. That is how we understand corporate finance and start to build on US Treasuries and the US Treasury Department. What is government borrowing and how do government bonds fit in to the entire world of global macro? Our goal is to ultimately understand liquidity in our modern framework. But in order to get there, we have to go step by step. And I want to start today with some fixed income basics now that we have some of the corporate finance basics from lesson 1. Today, we're going to go through fixed income 101 session. We're going to focus on market structure. So what is fixed income? What does it include? What are the securities in there? We're going to talk about capital markets. How do capital markets interact with the fixed income world? Then we will talk about the Fed and the US Treasury. So what is the Federal Reserve? How does it compare to the US Treasury? And how do banks step in to this process of getting US Treasury securities from the government into the market? Now let's start with an interest rate that everybody out there following financial media might be aware of. And through this first chart, we will start to unpack really how big the fixed income world is and why just focusing on the central bank really misses the big picture of this sector and this asset class. So this first chart is a chart of global central banking rates around the world. You will see in orange here, the Fed funds rate. Now the part that's light orange is future pricing expectations of that rate, but the solid line going back is the actual policy rate. In red, you have the Bank of England central bank rate. In lavender there, you have the Bank of Canada. In black, you have the Royal Bank of Australia. In green, the European Central Bank, and in navy blue, you have the Swiss National Bank. These are some of the major central banks from around the world. And you can see here, very easily, you can see that global policy rates from the global central banks are quite coordinated and move together. This is because from the 1960s, these central banks have been meeting at the Bank for International Settlements in Basel and coordinating on policy. This does not mean that Basel tells these central banks where to move their rates, but it does mean that these central bankers are working together. Now, the orange line is the Fed funds rate, but the Fed funds rate is a central banking overnight rate that has a disconnection with the rest of market interest rates. So we're going to be spending a lot of time on US Treasury rates, not the federal funds policy rate, which is the Fed funds reserve rate that you see here in orange. But through time, we will start to teach more. What is the Fed's role? What are the role of some of these money market rates? And how does the Treasury yield curve play off of this? Over 10,000 investors downloaded the original How to Position for the Bitcoin Boom report when Bitcoin was 27K and it called for 120. The target is hit. What's next? Tour de Meester is back with the 2025 edition, refreshed for the mid-cycle moment. New data, new insights, and get Tour's latest price expectation. Plus, you'll get exclusive access to charting our way through chaos. Tour's new 30-minute Q3 2025 presentation. He explains why this bull run might just be beginning. Read the first ever mid-cycle report from Adamant Research at unchain.com/TBL. Blockstream, where the future of finance runs on Bitcoin. Go to store.blockstream.com and use code TBL for 10% off. Pick up a Jade Plus hardware wallet. It integrates seamlessly with your Blockstream app
and it's the perfect way for both pros and beginners of Bitcoin to get started with your cold storage. Store.blockstream.com, use code TBL for 10% off.
All right, a little bit about fixed income market structure. Now, what is the size of the fixed income market? It's well over $120 trillion. So this is a measure that is changing, of course, every day, but the amount of US Treasury securities at $37 trillion is only a sliver of the entire market structure. Now, what are fixed income securities? They are simply loans that have been classified as securities. A security is simply a legal construct. It is a result of regulation, such as the SEC Acts of 1940, the Securities Act. These are some of the legal classifications that are required for a loan to become a security. And in the fixed income world, it's dominated by securities that follow or fall into the SEC's regulatory requirements for fixed income securities. Fixed income securities, which are loans, function a lot like basic loans in that loans are taken out by people or by companies to invest and to grow their business. Fixed income securities fit that same role. Governments and corporations both are using the fixed income market. Corporations are using it to then borrow and invest, and governments are doing it to borrow and spend, whether it's on military or on social benefits such as Social Security and Medicare. One of the important things that governments use fixed income markets for is for developmental projects. So a government can borrow money, build out infrastructure, and hoping that that infrastructure build out then increases the productive capacity of the economy, thereby increasing economic growth and bringing more tax revenue into the government to eventually pay down that borrowing. Now, we know today that with 37 trillion of US Treasury debt outstanding, the US government has borrowed a lot more than it is bringing in and has the ability to pay down on its debt. That is a topic for later lessons as we get into it, but for now we have to understand what these securities are and what they are used for. Now, who are the lenders? The lenders or the buyers of these fixed income securities, they are people or investors that are looking for a fixed return on their capital and something that is somewhat guaranteed. So buying a US Treasury security that yields 4% for 10 years will get that investor a 4% dividend, or what's called a coupon in the fixed income world. That coupon will be paid every year. In Treasuries, it's twice a year. So you take 4%, divide it by 2, they get 2% every 6 months. And that 2% every 6 months will compensate them for the risk of dedicating that capital for the time being. Now, other instruments that are not US Treasury securities will have more risk than the US government will. So, for example, if an investor wants to lend money to Apple, then it will buy an Apple bond and get, for example, 5% over the next 10 years instead of 4% from the US government. One important component of fixed income securities is that the buyer of the security does not take an ownership stake in the entity. It is a loan, and that loan will be repaid, and the fixed income security has a maturity. At maturity, the security expires, the cash is returned, and the investment goes away. That's quite different than an equity security, which does not have a date of maturity because it is an equity stake, an ownership stake in the company. With this chart, we can see that fixed income is, in fact, a global asset class, about 40% of it US based, 20% of it in Europe, 20% of it in China, and then throughout the rest of the world, fixed income securities exist in every corner of the financial system, and governments all around the world use the fixed income market to borrow. The fixed income market also includes different sectors other than just US Treasury debt. It includes mortgage-backed securities, which are instruments that have mortgages in them. So the buyer of a mortgage-backed security is ultimately the lender to the home buyer. We also have credit, which is the shorthand for corporate bonds. Any corporation that is borrowing in the fixed income market is classified as corporate credit. And also very important to the Bitcoin layer, money markets. Money markets include all fixed income securities that are less than 365 days to maturity. So these are fixed income securities underneath 1 year. And money markets function as money in this financial system, meaning that they are equivalent to cash in many ways in many parts of that money market sector. So that's something that we will explain a little bit more. All right, let's talk about the capital markets a little bit. You guys know that when you go to your brokerage account and you want to purchase an equity, you look up the ticker for that equity, and through that ticker, you can buy an ownership stake in the company. So for example, we know the ticker AAPL. So we're going to buy Apple stock. We look up AAPL in our brokerage account, and that's how we know we are buying Apple stock. Well, what about fixed income? How does it work in fixed income? Do you look up US Treasury and go buy a US Treasury security? It doesn't quite work like that. In the fixed income world, we have something called CUSIPs. These are identifiers for individual bonds. Now, we think about Apple as being one ticker that everybody that owns Apple stock has the same ticker. They own the same security, but not everybody owns the same treasuries. In fact, the Treasury Department is issuing securities almost every day in the market, and many times it is issuing brand new securities that are created on that day or that week. That is why the Treasury market has several hundred CUSIPs at any one time. You can think about a bond that was issued 30 years ago, and that 30-year bond issued 29 and a half years ago. Today, it's a 6-month bond, meaning that it only has 6 months to maturity, but historically, it was a 30-year maturity bond. And so that CUSIP, that individual CUSIP, has existed for 29 and a half years. On the other hand, a brand new 6-month Treasury bill that's issued today, it might mature on the same exact date that 30-year bond matures, but it will be a different CUSIP, a new identifier, a fresh security. And so when we think about the bond market being fungible versus the equity market, they have different characteristics in there. So if I want to sell Apple stock, I know that my 1 share of Apple is the same 1 share of Apple that the next person wants to buy. But in the bond market, just because you have a treasury security doesn't necessarily mean that somebody is looking for that exact treasury security. In fact, the securities with the highest degree of liquidity, and liquidity in this example, I'm talking about tradability. What can you sell the quickest for the market price? It's going to be securities that are recently issued. This is called on-the-run securities. One more note on capital markets here. Primary markets versus secondary markets. The term primary markets refers to the auctioning or the issuance of securities. So the first time that they are brought from the issuer to the investor, every other trade, therefore, is a secondary market trade. So we have the primary market and the secondary market. The primary market is where companies and countries come to issue, and only through healthy secondary markets can issuers access the primary markets, because the primary market buyer must know that they will be able to sell the security if needed. So a primary buyer, market buyer, needs a strong secondary market. In this next chart, we'll take a further look at the Treasury market versus other capital markets asset classes. The Treasury market here in orange at 37 trillion. Compare that to the New York Stock Exchange and NASDAQ market caps, combining for a total of 64 trillion. So you can see that almost double the size of the Treasury market. Then in blue, commercial bank deposits at about 18 trillion and money market fund assets at around 7.25 trillion. Now, who owns US Treasury securities? Well, it's basically everyone around the world that is an investor. Pension funds, mutual funds, banks, individuals, and state and local governments. You also have a lot of treasuries owned by the rest of the world. Those are central banks and governments, as well as investors around the world. So US Treasuries, a very widely held asset. In this next chart, I show you the economics of the Treasury Department, in that how is the Treasury debt that it has, how does that debt compare to the economic productivity of the country, and therefore the base of activity on which the government can tax, collect revenue, and pay back the debt. Right now, the US debt to GDP is at about 119%. Now, before I talk about the US debt to GDP passing 100%, let's go back to the balance sheet, because this is a very important thing. All right, I'm bringing back the balance sheet from lesson 1 here, where we look at the US government and its position. Now, we are talking about, in this 37.3 trillion in debt, we're talking about this liability side of the balance sheet. Now, can you show me where GDP is on the balance sheet? It's not. And this is a very important point that I want to make here. GDP is not on the asset side of the balance sheet. It's not even one of the projects that the government uses to create revenue. Remember that corporations, when they borrow, they are financing projects. Let's even go back to that slide when we're looking at the firm. Now, the firm is using borrowing, and it borrows from the capital market. These are bonds here. Okay, so it's using bonds to raise money. It takes that money and invests them into new projects. The projects then generate cash flow, which filters back down into equity through retained earnings of the company. Now, if the company takes this existing cash flow and puts another project in the works over here, puts more projects, then it doesn't send any earnings back to the equity portion of the balance sheet, but it will grow the assets and grow the cash flow. And then hopefully then they can grow their earnings per share with more projects. But we have to think about the government now. When they borrow money, they are investing in their people so that their people can generate more GDP so that they can pay back their debt. Now, the point about GDP is that GDP is not here. What is here? You have the land, you have the entrepreneurial spirit, you have the citizenry, you have natural resources. This citizenry part of the balance sheet is where the GDP is hidden. So GDP is in here, in that the citizenry are those that create GDP, the economic activity of the country. But you can see here how GDP is only one portion of this holistic view of the United States government. What if the natural resources of the country were 200 trillion or 500 trillion? then this equity portion of the government becomes over $150 trillion. Then the 37 trillion in debt doesn't look so big. So yes, the US debt to GDP has crossed over 100%. And yes, the GDP, this portion is smaller than the liability portion. But does that account for the financial standing of the US government? I would argue that holistically it doesn't, even though GDP is the measure that we can use to say, hey, this is how much revenue I think the government can collect every year to pay back the interest on this debt here. So now I want to show you a chart that starts to relate this item to this item, which is the citizenry creating GDP. And in this chart, the black line is tax receipts. So not necessarily the GDP itself here, but that cash flow that we were talking about. Because how does the citizenry create cash flow? Taxes. It pays taxes to the government. So the black line on this chart is taxes collected, and the blue line on this chart is the interest payment on the liabilities. So that 1.13 trillion is the debt service annual payment for the 37 trillion. Now I'm just grabbing my calculator here, and we're going to do this by hand. 1.13 divided by 37 trillion, we'll round it, and I'll multiply by 100. This is about 3.05%. So approximately 3% interest on the average interest rate, or I should say the average interest rate on the entire debt stock is about 3%, meaning that on 37 trillion, we have to pay 1.1 trillion a year in interest payments. So this, now you look at the red line, 32.4%. What that means is that the cash flow here created by the citizenry, the cash flow here is 32.4% taken up by the annual debt service cost of the liabilities. That's how we start to relate these numbers that you see on our macro bond charts and you read in the financial media to the balance sheet. We have to stay anchored in this balance sheet approach to really understand fixed income and US Treasury securities. This is another great chart, a follow-up to the previous chart here. Now you see that tax receipts line, which was previously in black at 3.5 trillion. Now you see that as a percentage of GDP. So what percentage is this black portion of the GDP? So this GDP is the citizenry, the asset of the government, the ability to produce economic activity and pay taxes, but then are those taxes being collected to help the country pay back its debt? And what we can see here is that about 11.5% of GDP is being collected into taxes, which can then go to service the debt. How does that compare historically? Well, you can see that in 1950, the percentage of tax receipts in terms of GDP was much closer to 14 to 16%. And that in the year 2009, 2010, it fell down all the way to 8%. So right now, taxes as a percentage of GDP, about 11%. Can this rise or fall? I don't have a great take on that right now, but what we have to understand is that the asset of the country is the citizenry and its ability to produce GDP. And then it's the government's responsibility to convert that GDP into tax revenue, which it can then use to service its debt. That's all the time we have for today. We talked about fixed income market structure, capital markets, and a little bit more about what the US Treasury debt means in the context of US GDP, the US balance sheet, and the US's ability to collect taxes. Next time, we will get more into the Fed and the Treasury and how these two entities interact both within the government and when they involve the banking sector. Thanks for sticking with us, and make sure you catch Bitcoin and Liquidity Academy every single week here at the Bitcoin Layer. We'll catch you guys next time.